Good afternoon, everybody. Thanks for joining us for this second discussion today and the fourth as part of Surety Week 2023. This is, of course, an important topic given the current macroeconomic situation. We're going to be talking overall about the response to inflation, what it means for the surety market, what insurers need to realize, and also hopefully what others in the industry might need to think about when they consider the impact of inflation. We are meant to have another member of the panel who is having a little bit of trouble joining us, but will shortly be with us. He's just dropped me a message to say he's on his way. But as we wait for him, let us start with a quick round of introductions of those who are here right now. Christoph, could you start?
Yes, sure. Thanks, Daniel. Yeah, my name is Christoph Paffhausen. I'm working for Atradius bonding unit. I'm located, as you may see from my background, in the beautiful city of Cologne. So what you can see is the cathedral. Yeah, as said, working for bonding since almost 3 years right now. I joined Atradius 20 years before, working for the classical credit insurance sector in several functions. And yeah, almost 3 years ago, I moved over to bonding, and I'm responsible for the so-called financial underwriting, meaning the credit analysis of our bonding unit. Yeah, unit-wide. So that's me, and I'm very happy to be here this afternoon. And thanks for the invitation.
A pleasure. Ken, good to see you. Roberto, we'll start with you and then give Ken a chance to set up.
All right, thank you very much, Daniel. So Roberto Castillo is my name. I'm working for Hannover Re in the Credit, Surety and Political Risk Division now since 25 years. Before that, I used to work for the primary insurer in Cologne, so I had the same background as Christoph. And yeah, my background here, I'm not a ghost, so I'm real, but even if it looks like I'm a ghost. And happy to be part of this panel and hope for an interesting conversation.
Great, very happy to have you also. Ken, please introduce yourself.
Yeah, hello everybody. Hopefully you can hear me okay. My name is Ken Wattret. I'm the head of European Analysis and Insights at S&P Global Market Intelligence, based in London. We do a wide range of macroeconomic forecasts across the globe. My historical specialism is Europe, and I'm happy to join today to talk you through our expectations for inflation and how it will evolve going forward.
Excellent. Well, we've definitely got quite a few different perspectives for this conversation, but perhaps, Ken, if you can give us a little bit of a background or a bit of a sense of where things are, what has happened, why we have high inflation, and some of the other scene-setting points, if you could take that away.
Yeah, absolutely. I have a slide deck that I can share. Should I share it with everybody?
Yeah.
Okay, bear with me a second. Trying to
No problem.
Trying to do that. Just hang on. Okay, so for some reason, technical glitches are getting in the way, and I'm unable to share. It seems. Not quite sure why that would be.
If you want to send it to my colleague Owang, and he can then put it up that way. But otherwise, if you want to get started, and we'll work on that behind the scenes.
Yeah, it's going to be difficult for me to send it while I'm speaking at the same time.
Sure, of course.
That's the problem. Okay, so look, maybe we could send it round after the event. So the way
Sure.
I would look at the situation is, how did we get into a situation where global inflation has taken off? Obviously, there are different regional and country variations, and prices are not rising in every sector at the same speed. But in 2021 and 2022, we've seen consumer price inflation take off. What's behind that? Well, we can list countless factors which have driven that. Some related to specific shocks to do with COVID, then subsequently to do with Russia's invasion of Ukraine and its spillovers. We've had, huge disruptions to transportation of certain goods. We've had big increases in import costs. We've got labor shortages and so on. The list is very long, but you could characterize these from a macroeconomic sense. I think, as a combination of adverse supply shocks and positive demand shocks. So that positive demand shock being that the global economy came back from the pandemic much more quickly than had been initially anticipated, supported by a range of different policy measures, turned out to be much more effective and much more immediate than most forecasters, including ourselves, expected. So on the supply side, we've had the inability to match that, rebound in demand, through a number of different impediments, including to supply chains, labor, and so on. So the question now, I think, is, how would we expect inflation to evolve? And the way that we would answer that is to say, well, how will the interaction of supply and demand evolve? And we've seen over the last few quarters, again, with some variations, a clear weakening trend in demand. Now, we've had some uncertainty as to how severe this weakness will be. In our base case, our colleagues in the US expect a recession, technical recession, this year. In Europe, the economy has slowed down quite markedly, but it looks as if the severe energy-related recessions that were being speculated upon last autumn are not going to materialize, but effectively in the euro area, the EU, for example, economies are pretty much flatlining. And actually domestic demand is weaker than the headline figures would suggest. So we're already seeing on the demand side some weakening. Obviously, a key reason for that is the tightening of monetary policy that we've seen globally. We may be reaching the end of that as we progress through the first half of this year, but the impact of monetary policy tightening on demand takes quite a while to filter through. So we're going to see a much weaker growth performance this year than we saw last year. And on the supply side, various metrics that we look at, including those that we produce from our proprietary data set, the PMI indices, they're telling us that the supply side is also improving. So if we look at supplies delivery times, for example, from our manufacturing PMI, globally and in some of the inflationary hotspots like the US, continental Europe, the UK, we now see those delivery times indices back at levels that we hadn't seen since before the pandemic. So to us, it looks like global demand and supply are coming more into balance, and one would expect in that case that inflation would start to fall, and that's exactly what we are seeing. So it varies again depending on the economy and depending on the item in the consumer price basket, but we are seeing inflation rates across the globe moderating. Now, there's also a powerful technical factor which will drive inflation rates down this year, which is the base effects stemming from the impact of Russia's invasion of Ukraine and its spillover effects on certain commodity prices from the early part of 2022 through the year. And so those base effects, which are really powerful for food and energy prices in particular, will be driving down inflation rates, particularly in Europe, but not just in Europe, over the course of 2023. So we're expecting that the inflation rates that we see during this year and also to a lesser extent in 2024 will be much lower than we've seen in 2021 and 2022. Now, it's going to take a bit of time. And I think if we're, looking at the direction of travel is increasingly evident. We see in some emerging economies, inflation rates have already been falling for several months. We see increasingly in developed economies, in some cases, very sharp falls in headline inflation rates recently, including in the euro area. But to get back to the targets that central banks, consider to be consistent with price stability, inflation rates generally around 2% in the US and Europe, say, then that's going to take some time. We're not expecting that to happen until well into 2024. But the dynamic is clear. We've passed an inflection point. The question now, I think, is how quickly those inflation rates come down, and also the composition, because headline inflation rates include those food and energy base effects, which are very powerful, but core inflation rates don't. And core inflation rates pretty much look much more sticky, again, with some variations. So those underlying inflation rates are a concern for central banks. They're worrying the Fed, they're worrying the ECB, they're worrying the Bank of England, because they know that the headline inflation rates are being pushed down by these technical factors, the base effects. So what they want to see is evidence that slack is being generated in economies, that labor shortages will ease, and that wage pressures will top out and start to moderate. Now, of course, there are lags involved in this process. So when economies weaken, it takes a while for that to filter through into labor market conditions, and then with another lag, it will then filter through into wage growth, which is a key component of some parts of the inflation basket, particularly services prices. So we can't expect all of this to happen immediately. There will be different stages of the disinflationary process, but over the next 1 to 2 years, we think the concern about the exceptionally high rate of inflation and the potential knock-on effects of that onto inflation expectations and wages will start to ease. Now, there's a broader issue about whether the global economy is set for higher inflation rates in the future than we've seen in the past. So I think, again, it's quite helpful to separate these shorter term dynamics related to that rebalancing of supply and demand and the base effects from the medium term influences on inflation. And if we take a look back at the period before the global financial crisis and then afterwards, we've generally had consumer price inflation rates being reasonably well behaved. Obviously, in some emerging market economies where central banks may not have a credible inflation targeting framework, and where currencies may be in a persistent phase of downward pressure, then inflation obviously hasn't behaved anywhere near as well. But in many of the advanced economies, what we learned during the pre-pandemic decades was actually that the challenge central banks faced was getting inflation back up to their target rates. Inflation was persistently undershooting. When we analyzed why that was, then there were some structural disinflationary forces which were very prevalent at the time. Again, some of these are quite complex, but if you think about the entry into the global economy of lower cost producers, China is the obvious example, but also other faster growing economies who are increasingly taking market share, increasing their import penetration into advanced economies for goods, then that was keeping core goods inflation particularly low. We also had lots of different reforms to labor markets, more anchored inflation expectations, which kept wage pressures and unit labor cost pressures relatively well contained. So we had a period of relatively benign inflation, central banks doing what they could to actually push inflation higher in the advanced economies, creating a very benign set of circumstances for real economies, asset prices, financial markets. Now, of course, we face some changes in those structural disinflationary forces, and there's a bit of a balancing act here, because we still have some disinflationary pressures coming from things like technology and so on, e-commerce or price transparency, automation. One would still expect that they would lean down on inflation rates going forward, but we have some disruptive factors which may mean that era of global disinflationary forces is not going to continue in the future. So think about after the pandemic, after Russia's invasion of Ukraine, the importance of security of supply. With very complicated supply chains being put at risk by adverse shocks, there's a desire, I think, to reshore, to secure supply rather than necessarily get the best possible price for your inputs. And that trend, probably away from globalization combined with various geopolitical risks and concerns, probably means that we're past the era of persistent low global goods inflation. And the other factor that's obviously an issue now is, how persistent the reaction of wage growth might be to what has been an exceptionally high period of inflation. And if participation rates in labor markets remain lower in the future than they were prior to the pandemic, which so far seems to be the case, then we may see a continuation of labor shortages and higher than otherwise wage growth. And so we might well then be in a period where, although these very high rates of inflation from 2021 and 2022 diminish, we don't go back to persistently low inflation rates that we saw previously. And one of the consequences of that will be less accommodative monetary policy conditions and therefore more challenging global growth conditions. And these are some of the issues that currently where hear a bit of background noise. These are some of the issues that we're currently, trying to gauge, trying to get a clear handle on. And our longer-term global consumer price inflation forecasts are higher than we saw in the pre-pandemic years. It may be that there's a tendency to underestimate some part of the inflation basket in future, because there is, I guess, a pattern of kind of extrapolating the recent history into the future. So we feel very confident that we're at an inflation inflection point globally, and that we'll see lower consumer price inflation rates over the next 1 to 2 years. But looking beyond that and thinking about global trends, structural disinflationary forces, and potential shocks to the global economy, which may have legacy effects, may well be that the environment becomes somewhat more challenging. I don't think we're in for a return to persistent double-digit inflation rates, and some people have speculated about hyperinflation because of huge central bank balance sheet expansion. I don't see that happening, but I think a reasonable assumption would be that underlying consumer price inflation rates are higher beyond the next couple of years than they were in the pre-pandemic period.
Thanks, Ken. That's really interesting. I think it really sets the background to this. One thing that I was wondering before we go on to considering what the impact on the surety market is to what extent is this different to past inflationary periods? You mentioned that there's not really an expectation of return to sort of double-digit inflation as a standard thing. But to what extent is this a different period of inflation compared to, say, the oil crises and things like that in the past, or how does it shape up?
Well, I think it depends on which part of the inflation basket that we're looking at. So we look at the scale of some of the energy price increases that we saw during the 1970s, and then we compare them to what we've seen in the recent period. I mean, they're not comparable. The scale of the increases that we saw in the 70s were far, far larger, and the circumstances were significantly different. Also, the responses to those energy price impulses in the 1970s were very different than they have been this time. They were effectively accommodated. The assumption was that central banks couldn't do much about it. It was a supply shock that they couldn't control. But actually, we now know that central banks can do something about the second round effects. And if they signal, as indeed they have been doing, that they're determined to react to those energy impulses and keep inflation expectations in check, then one would hope that that would have a limiting impact, on those second round effects. That yes, we'll see a catch up in wage growth, but it's going to be a one-off. It won't be persistent. So not only the nature of the shocks that we saw in the 70s, but also the responses to those shocks are quite an important differentiating factor. But that's not to underestimate the risks, and particularly in the economies where, like I was saying earlier, the inflation targeting frameworks from central banks either don't exist, or they're less credible, or an economy may be persistently importing inflation through exchange rate depreciation. In those cases, and we have some examples of them currently, of course, then the genie is out of the bottle, as it were, and those inflation rates are likely to remain persistently higher. Yeah.
Christoph, if I can turn to you for a moment as well to get your view, given that you're a primary. We know that, say, commodity prices are going up. We know that there are labor shortages. We know there are a lot of issues that one would think probably have an impact on the surety sector. So how are you seeing the current period of high inflation?
Yeah, how do I see it? I would say it's a challenge to transfer or to implement what Ken said into the daily business of a surety underwriter, and I will give it a try. So first of all, what Ken mentioned, I can fully confirm, we are not faced with a hyperinflation. So we don't see a complete devaluation of money, of course. 8.5% average inflation rate in Europe is unusual, is a kind of stress scenario, no doubt about this. But as said, we're not faced with a hyperinflation. We see all kinds of increases of costs. We see increases of labor costs, material costs, subcontractor costs. This is the basket, the inflation basket that Ken already mentioned. But of course, we also see increasing volumes of business, even though that these bigger tickets, these bigger deals here and there are also already postponed, especially if you see the real estate development sectors. Bigger projects are parked at the moment because people wanted to see or monitor the development of price increases and founding costs. And also we as surety providers, as underwriters, have to monitor this development. Currently, all companies, all business models are under pressure. Sometimes it's not the real inflation in the narrow sense if we see the definition, but as Ken already alluded to, all external events and developments also cause this kind of price increases and the pressure on the business models. Especially, we have to keep a close eye on the margin developments of the companies, of our customers. In the past or in times where we see price or stable prices, this was already a very, let's say, strong argument to look at the very well-filled order book. But at the moment, of course, we have to distinguish between an order book which has a long track record, which has a long tenure period in the future, where the companies need to have a professional monitoring and in order to secure their margins. So we have to assess and to analyze the structure of the business. If companies are able to pass on the increased costs to their final customers, and which instruments they have implemented to secure the sufficient margins to be able to finalize their businesses and projects with a profit instead of running into a loss scenario. So this to give as a first statement and indication.
Yeah. Roberto, I guess you would probably have a similar perspective, but again, you're coming from the reinsurance side. Does that change how you view the situation?
Not that much. So I really don't have another story, as we sit in the same boat as Christoph does. So probably with some delay, but at the end the observation is the same. I think with regards to the specific situation of the inflation we suffered last year, probably is that it was some kind of a surprise. What a sudden inflation which really came and caught us without preparation, especially in certain countries where we are not used to inflation. So I think we had one or two generations, and even two generations, some countries that have never suffered an inflation. It was like a scenario where everything was pluralized at that moment, and nobody really knew what to do. But of course, what Christoph said, I think the observation of the companies, especially in the construction sector, with the cost of labor, of material, everything is really going up, and all the calculations which have been done for certain projects, they are not the same anymore. And we have seen then in a lot of countries where even projects, even larger infrastructure projects, which were projected for the upcoming years and which already had been budgeted, they have been deserted just due to the uncertainty of what's coming up. So it's I think both. It's the inflation as such, which has come, and I share Ken's view. It's not here to stay at the same level we have seen in the past years. It will stay for sure, but at a more moderate level and probably in a more predictable level. I think the main problem is really it was unpredictable when it came, and it increased the cost for a lot of sectors, and not only the cost of the daily work. I think the relation between inflation and then the increasing interest rate is also increasing the cost of financing for a lot of companies, a lot of sectors, which are coming from a period of COVID, where they are still recovering, and I think this is a big shock, and a lot of companies will need some time or even some help to overcome this situation.
Yeah, and Roberto, I know you work also in Latin America as well, where for many countries higher inflation is the norm. what do you think? Do you see anything that works there that maybe is something that can be brought into European markets where this is much less well known of a phenomenon?
I would say the effect is the same. I think inflation is inflation and has an important effect on the economy and also on the value of your money. Yeah. And so if we suffer from an increased inflation, they suffer even more for a more increased inflation. So I think it's a legend that the Latins are just cool when the inflation comes. So they suffer the same way we do. Probably they are more used to that and are more serene and really know what to do in the moment. And they have also some tools with regards to the management of the costs, like increasing salaries every quarter, and all this kind of issues to adapt to the situation. But I think the devaluation of your money is even higher there. Regarding what Ken mentioned, yes, you have another tool which is the currency devaluation, which comes with that, but it's not helping you for a longer period. So I think in some countries they have this spiral of inflation. And the companies, they are suffering the same way and even more than we do in Europe. But they are not as shocked as we are, probably.
Yeah. Well, Ken, maybe if I could ask you, you mentioned hotspots when we talk about this period of high inflation. And we know, those of us who are in Europe, we know that there's a big focus on the cost of energy here, as well as other things. How is this playing out in other regions? Is there a drastic difference between what's being felt here in Europe versus what's being felt in Asia, for example?
Well, I think if we highlight those particular price segments where we've had idiosyncratic shocks, yes, we do see some differences. I mean, if you look, for example, at gas prices and wholesale gas prices in Europe in the late summer, early autumn of last year, they peaked using the TTF as a benchmark at a level that, would have been considered inconceivable not that long before. 300 euros per megawatt hour TTF benchmark price peaked briefly in August of last year. Thankfully, it's moderated since. So the current run rate somewhere in the mid 50s. At least the last time I looked, it was. Obviously, it's very volatile. And, we've seen a change there because of relatively favorable weather, thankfully, during the winter. Shift in demand patterns, there's been efficiency savings, so the demand for gas has gone down. Storage levels are high. Alternative sources of supply have helped. But for a period of time, it looked as if shortages of energy and extreme energy prices could push Europe into a severe recession with all of the spillover effects from that. Think about the impact on labor markets, asset prices, and so on. Now, we've avoided that, thankfully. But if you look at other areas, then there have been price pressures which have had very little to do with those geopolitical factors, but much more to do with the disruptive effects of COVID. So if you think about used car prices, for example, we've seen used car prices, and this is prevalent in many economies, but it's been particularly the case in the US, played a really big part in the surge in underlying inflation rates, which had been trending somewhere around 2%, in some cases a little higher, in some cases a little lower, and then have rocketed 5-6%. Again, the kind of underlying inflation rates that we would have considered highly unlikely not that long ago. And so why did we see that big increase in used car prices? Well, because we've had disruption to supply of key inputs, which have delayed the production of new vehicles. And so if supply of new vehicles couldn't be increased, then demand for existing vehicles was strong and supply didn't match, so the price shot up. Now, what we've recently seen is some unwinding of those inflation rates. Again, base effects are really important. They push down if you don't see the same increases in the subsequent year as you saw in year one. But we're not going to see those prices go back in full to where they were previously, because prices tend to be much more sticky downwards than they are upwards. You know, so we're seeing a big shift in the price level as well as just the rates of inflation for many items. And I think the biggest worry I would have in the period ahead would be services inflation rates in many economies, because if you differentiate between goods and services, you could say, and it's a little simplistic, but as a broad rule of thumb, you could say that goods inflation rates are much more influenced by global factors, trends in commodity prices, supply chain developments, and so on. And most of the leading indicators for goods inflation are pointing sharply downwards, thankfully. You know, again, using our own data, the PMI for the manufacturing sector, you know, we have input and output prices, and they've really come down a lot. And other surveys produced elsewhere show similar things. Producer price inflation rates too, they've also started to come down. But on the services side, they typically are much more domestically orientated. Now, that doesn't mean that, you know, an energy shock doesn't matter. Clearly it does. The cost of transport can have an impact on services prices and so on. And, you know, if individuals push for higher wage increases to compensate for, you know, the increase in the cost of living, then that will filter through to the service sector channel. And that would be my worry, that we have quite a lot of lags in this process. As was mentioning earlier, it takes a while for a downturn in economic activity to impact on labor market conditions, for some slack to emerge, and then in turn for wage growth to moderate. So we could be living with quite sticky service sector inflation rates and worries about wage pressures for quite a while. So that then has a knock-on impact on monetary policy prospects, and then in turn growth prospects. Because if you think about where the Fed is now, or where the ECB is now, you know, they're getting to the point where policy rates are already quite restrictive. They're signaling that they've gone from 75 basis point increases, certainly in the US case now, to quarter point increases. And they're getting to the point where they're thinking maybe that they've done enough. Now, historically, the gap between the last rate rise and the first rate cut is typically quite small, because central banks keep on tightening, they realize they've overdone it, and then they go into reverse. Right. It might be this time, if inflation's a bit more sticky and underlying inflation rates are higher, that the gap between the rate hikes and the rate cuts is a bit more elongated. And so we may not get that relief from a turn in monetary policy coming through as quickly as in the past. And that's embedded in our forecast, actually. We're not expecting right. Fed rate cuts and ECB rate cuts until well into 2024.
Okay. There's a question that's come in that's quite interesting, and just a reminder to our audience that you can put a question to the panel if you go to the tab on the bottom right of the page. Maybe Christoph and also Roberto, the question is if you're aware of any contract surety losses where the primary cause of the loss, contractor failure, was inflation or supply chain issues. We can't really talk about specific cases for obvious reasons, but are you aware of say an increase in these kind of issues coming up where there are losses? Is that something you're seeing?
Yeah, the question is about significant losses.
Yeah.
I would say I'm not aware about significant losses so far. Of course, there are customers who went into insolvency due to several, let's say, problems or okay. We have to assess that the supply disruption, as Ken mentioned during the lockdown, of course, also caused very negative impact on the production cycles of companies. So first of all, there has been the lockdown. So production has been slowed down or was closed. Then it was postponed for 1.5 and 2 years. Now the economy or the companies got better, recovered, and now they run with the same contracts as they have signed before the lockdown into this inflation scenario. So if we think about SLAs all over Europe, which have been agreed in order to compensate the inflation by higher salary costs, here and there we're talking about +7%, +9%. So if you imagine that the raw material prices are increasing, that the energy costs are increasing, if as I said, the salary costs are dramatically increasing, and then you have to deal with the same contract as you fixed it before, then of course it's quite obviously that then you run into a big trouble. So and then you have to really be, and this is for me one of the key messages or the key word, you have to be flexible to adjust your contracts, to adjust your supply chain, to discuss prices with your suppliers, but also with your end customers. This is the big management challenge that nowadays companies are faced with.
Yeah, I really agree. So we also did some scenarios on that, and what would be a typical claim. So an insolvency of a company, well, it can have various reasons. So the inflation and the higher cost of material or financing could be the final trigger, probably to cause a loss at the end. But it's in the end, it's like every time you have a contract, you need both parties, and both parties need to be flexible. And as we are not used to have any indexation clauses in Western Europe, in some countries, of course you run into this problem. And then the question is, how interested is the beneficiary to negotiate, and how interested is he in getting the works done, and how flexible is also the contractor to just take this higher cost, or both take part of this higher cost. At the end, it's a question of negotiation. So if both react strictly with regards to their contract, then we would have a lot of claims in future. That's for sure, because all the calculation, the cost calculation, which has come before, is not real anymore, as the inflation was just sudden, and so there was no time for adaptation. So at the end, it will be a question of negotiating and finding good solution for both parties. And we cannot expect the banks to help out. So they will have their own interests, and they will give no cheap credits today. So that's I think one of the big issues will be financing, at least in our view.
Yeah, well, I guess you both sort of mentioned that this is something that hasn't really been seen in a lot of the markets that you're working in, and to a certain extent you need to change your approach. Maybe if we can touch on that, sort of what different things do you need to look at within your business because of the current situation? Or maybe it's nothing to do with inflation per se, maybe it's where we are in the macroeconomic cycle generally. Christoph, are there things that you're changing, that you're saying to underwriters in your team to be mindful of, more mindful of, as we're going through this period?
Yeah, sure. As I already said, margins are in the focus nowadays of our risk assessment. In the past, the mentioned well-filled order book was always a very strong positive argument to come to a positive stance. Nowadays, it's the challenge in the risk assessment, or it's the challenge in the analysis of company figures. Then we have intensified our contact to our customers in order to discuss business models, in order to understand about their production circle, from where they are getting their raw materials, to whom they are selling the final products, in order to see, are they able to manage, are they able to deal, are they able to replace, for example, the supplier, are they able to renegotiate what Roberto said. They're already fixed contracts. So in the past, it has been, I would not say a pure figure and risk assessment on balance sheets. That's of course also the circumstances have been of quite importance. But nowadays, it's not just looking at figures. It's about discussing. It's about to understand what is the company doing. How are they able to react on the current situation? So we are more talking than analyzing balance sheets. So this would be the big difference towards former days.
Yeah. Roberto, what do you think?
Well, we as a reinsurer, we don't have specific measures. So we trust that Christoph is doing things good. and that's what we can do at the end of the day. Is, of course, we can assist where we can, but as we are not a primary one, we will not negotiate with contractors and beneficiaries, so we would not be part of this. But of course, we observe the main risks we have, and we try to stay in contact with our clients, which are the primary insurers, And of course, we have also a list of certain projects of certain contractors. We also have a global view on some issues which are going, and we share that with our clients. But we won't interfere into direct contracts.
Right. Yeah. Ken, if I can go back, you mentioned as well, obviously, some of the impacts are very key in certain sectors. Are there particular sectors that are standing out as more heavily impacted by this, that maybe will struggle more to recover than others? You mentioned services is one where pricing may go up, but I guess also on the labor side, that'll obviously affect the construction sector and some of those heavier labor force sectors.
Yeah, it's a good question. I think, again, it's about the interaction of supply and demand, really, for those areas. I mean, if we look at where some of the hotspots were in 2022, then they had very little to do with the war in Russia and Ukraine, much more to do with pent-up demand for certain services. So if you look at, for example, restaurants and hotels inflation rates, again, using Europe as an example, there's a big seasonality to the demand for those items, and we saw over the course of last summer that inflation rates really took off. So to give you a numerical example, if we look at that particular part of the CPI basket for the euro area, prior to COVID, the trend was about 2%, so broadly in line with the European Central Bank's inflation target. The peak that we saw in inflation for hotels and restaurants last summer was 8.5%. We've seen variations in the past. It might have softened a little, 1.5%, or be running 3.5%, maybe a bit higher in some economies. But to go from a trend of about 2% to more than 8% is pretty remarkable. Now that was because we had a strong buildup of pent-up demand for that part of the economy, because during the lockdowns and then initially in the first wave of COVID, and then subsequently a lack of appetite or ability to travel, then people were kind of compensating for not having gone on holiday previously by maybe paying for more expensive holidays, or treating themselves in 2022. And so the ability to push up those prices was clearly evident. So we have to think about the particular factors driving the different aspects of the inflation basket at a point in time. Now, my guess would be we're not going to see the same thing repeated in the summer of this year. So the inflation rates for those more seasonal and pent-up demand related items will come down again. They'll moderate probably quite quickly because of the base effects of exceptional price increases last year. Then you have some goods prices, and you think, well, if we're now in an era where there's a trend away from moving to lower cost economies, where it becomes more difficult to offshore, where you're worried about access to supply chains, then a lot of goods price inflation rates are likely to be persistently higher in the future. So again, it really depends on what you think is driving the underlying dynamic of those prices. But there are huge dispersions, as we would call them, between different parts of the basket. But in general, if you look at the measures that show how broad-based price increases have been, they've been signaling for a while that actually they're exceptionally broad-based. So we do one for the euro area, which we know the European Central Bank has referred to previously. They look at the share of overall HICP inflation rates, which is running in excess of their 2% target. The trend in this in the past has been pretty low, something like 20-30%. Currently it's over 80%. So you could sometimes say that you should look through a shock to inflation if it's driven by one or two particular factors, and it's not broad-based. But we've seen that this has been broad-based across a lot of different components, and that's why central banks, I think, have been very, very worried. And as we go forward, obviously we'll be able to keep doing that analysis and to see whether the moderations just reflect exceptional factors or whether they reflect something broader. We think we will get evidence that this is a broader-based moderation in inflation rates, but in some areas it might take a while to see, and in some areas we might not see it at all.
Yeah, I guess to some extent then that what we're seeing is not an issue in and of itself. It's a continuation of a lot of what happened during the pandemic, and it's I guess a symptom rather than the issue itself. Would that be a fair way of putting it?
It would be, with one huge caveat, which is, inflation can become self-perpetuating.
Mm-hmm.
Those second-round effects that we're talking about. If policy isn't set to ensure that those second-round effects don't materialize, then you can end up, with a wage price spiral, and that wouldn't be our base case for most of the economies that we look at.
Yeah.
But in some parts of the world, that's probably already happening, where there are extreme labor shortages and where pay growth is really accelerating. But even in the advanced economies where inflation targets are well established and where central banks have that as the main point of their compass, you could have a situation where if inflation rates counter to our expectations do remain persistently high, that you get locked into a cycle of pay growth adjusting, prices going up, and the same again happens in a kind of self-fulfilling prophecy. I'd say that's more a tail risk outcome than a likely outcome, but it's become more likely today than it was previously, because inflation rates are first of all so high, and because we see labor shortages still apparent in a lot of sectors. So it might be that the cost of bringing inflation down is that central banks have to force recessions. And so one of the scenarios that we're thinking is possible, again, it's not our base case, but that the Fed, as the central bank that said most explicitly that they're in this for the long haul, they're going to bring inflation rates back down. They may actually find that they have to keep on hiking in order to get what they want, because you look at the labor data in the US in recent months, job growth is still very strong. Pay growth has moderated, but it's still much more elevated than it was pre-pandemic. So maybe the Fed just has to keep on going. They may not be able to engineer a soft landing. It may be that the cost of bringing inflation down is a recession in the world's biggest economy, perhaps elsewhere, with a lot of spillover effects, through the trade channel, the confidence channel, financial markets. We've seen equity markets rally recently on the basis that inflation's moderating and everything's going to turn out fine. That rally, is predicated on an assumption that inflation is going to fall pretty quickly. If that's not the case, and the world's major central banks realize that they have to do more, then we may have to go through a recession before inflation looks like going back to where central banks would want it to go. Yeah,
that's a fairly grim possible outcome, I guess, but that's a certain reality that may come to pass. And related to that, I guess, is a question that's just popped in. Maybe we won't talk about the specific loss ratios of either of you, but do you expect, to Christoph and Roberto, do you expect loss ratios to increase, either as a result of inflation specifically, or just generally as a result of an economic downturn of some description?
Well, I suppose they will increase at one point of a time. So we are coming from a period of very low loss ratios and a very low level of insolvencies due to various reasons. I think it's starting with COVID and all the help and assistance which was done by governments and all institutions in order to not make this sanitary crisis also an unemployment crisis. So everything was really done to keep the companies running, and there was a lot of liquidity in the markets, and so we still have a lot of companies around. Probably we have some kind of oversupply of in certain sectors that a certain level of consolidation may come in future. So this comes in addition now. And now this inflation comes and higher costs are coming. So the day will come where we will again have a higher level of insolvencies, being it due to a recession in the US will have an effect on the rest of the world for sure. The other question is if an increase in insolvency will translate to a higher loss ratio. That's of course a question of portfolio management and claims management of the individual insurers, and that's something which we don't foresee to which level, to which extent the loss ratio may increase. It will increase. That's something that will come, but it's unpredictable really to say to what level it's going to increase. That's very difficult to say.
Christoph, you seem to be agreeing there.
Yeah, yeah, I fully share what Roberto said. First of all, we have to notice that this year's, or let's say last year's 2022 loss ratio was at the beginning of the year already expected to be higher than the years before, and finally it turned out that it was lower. So last year's claims ratio was on a very, let's say, I would not say all-time high, but a really low level. So now it will increase. To answer the question with a clear yes, we have to see what will be the materialized increase, and secondly, how to deal with that. So it will be definitely important to get familiar with the new old situation, to accommodate with this and not to overreact and to get panic. Because if we see claims ratios of around, let's say, 30-35%, in the past it was quite normal. And as said, now it would be important to be realistic and to deal with such increases, even though that I, of course, also don't know how far it will go.
Yeah. Another question that's come in, and we've kind of touched on this a little bit, but it's about, I guess to Christoph and Roberto in particular. Do you see a changing outlook from financial institutions, from banks and others, when it comes to new limit commitments for example, the construction industry? Are you seeing a change in how they're approaching it? Christoph, why don't you go first?
Yeah, I can just speak for myself for the surety business. Yeah, as I already elaborated on, of course, the sector is on the high pressure due to several external influences. It's not just the inflation, it's the basket, how can describe it, which I don't want to repeat now. Yeah, we are still willing to support the sector. We are still granting and issuing bonds, no doubt about it. Of course, there is a kind of selection process. Of course, there is a more intensified assessment process, but I would not say that it's a general red sector without the chance to get any new commitments. Then we, of course, have to also negotiate prices. But of course, there is definitely a no-go. Mm-hmm. Or to put it in a positive way, yes, we are still willing to support and to issue bonds.
Roberto, any thoughts?
Yeah, we will continue also to give capacity to issue, or we don't issue bonds, but we really give the capacity to the underlying risks which are underwritten by our seeding companies. But of course, it depends very much on the accumulation and also on the cost of capital it really had at the end of the day, as we also compete with the capital with other entities, and the high interest rates probably attract other investors to other sectors. So that's a question that we have to look internally. And to your initial question with regards to banks, they will do their homework for sure, and they will probably, and that's something we are seeing, they are becoming more strict and more selective with regards to giving loans or giving just issuing capacity to certain contractors. So they are more restrictive probably than we are.
Okay. We're coming towards the end of the discussion. Just to point out to people, Ken's slides are available in the handouts section. So if you click on the apps button in the bottom right hand corner, there's a handouts button there, and you should be able to find them. Maybe Ken, if I could ask you for a final thought, sort of crystal ball gazing, what is the silver lining on the horizon? Is there something that we can go to bed tonight and go, at least Ken said that positive thing about where we are?
Well, I think there is one, as I mentioned at the beginning, that we're already seeing signs that inflation rates are coming down. So this is not just a forecast; this is the reality, and it varies depending on the economy that we're looking at. But if you pick some of the emerging market economies, Brazil as a case in point, the consumer price inflation rate there peaked back in the summer of last year. It's already fallen quite markedly. Its central bank was one of those that grasped the nettle much earlier on, started raising interest rates more aggressively. And it's turned the corner a little earlier. But again, as I was mentioning, with the US, we've seen a headline inflation rate falling for several months. The core inflation rate, it's still very elevated, but it's down from its peak. So the reality is we're already seeing inflation rates come down. It's only a matter of time before we see that spreading. The other thing I would mention actually is a point that Roberto was making, which is about the approach of banks in terms of the credit standards that they apply to loans. We have quite a lot of data on this, which is available, and absolutely credit conditions are being tightened. We notice in Europe actually with the ECB's latest data that credit standards are being tightened across all types of loan, but particularly we see construction-related activities being impacted, and demand for loans actually also in the household sector has fallen off a cliff according to the ECB's data. So on the supply and the demand side of the figures that we've seen recently, it looks like things are shifting. So that's an important issue that you were alluding to earlier. Are we seeing a variation in the sectoral risks? Well, I think we are, certainly in banks' attitudes to lending and their appetite to extend credit. The more interest rate sensitive sectors of the economy you would already expect to underperform in this environment, and that's particularly the case if credit conditions are relatively tight there.
Yeah, I think that's a very good point, and I think that probably wraps up the conversation, unless either you, Roberto or Christoph, have a final point they want to add. But I just want to thank you all for taking part. Christoph, Roberto, and Ken, thank you very much for your contributions. Thanks also to Guadalupe, who was supposed to join this conversation but was unable to in the end. But really appreciate her input to the preparation for this. And thank you to those who have provided questions during this panel discussion. I'm sure this is a topic we'll probably come back to as things evolve over the next few months. Later on tomorrow, so we continue with Surety Week tomorrow, and in the morning we've got a discussion about financial guarantee, which I think plays into a lot of this discussion that we've just had now. And I'm sure that's already one that we're seeing an awful lot of interest in, so be sure to join for that one. And then in the afternoon, we are looking at underwriting a private equity-owned company. So again, this all plays into the overall macroeconomic environment and how things are changing, but two really interesting topics. So without further ado, then I'll thank everyone again, and hopefully we see you tomorrow for the next part of Surety Week. Thanks, everyone.
Thank you very much.
Thank you.
Bye.